All right, I'm here. I'm here. It's having some technical difficulty. All right, I don't know. Had technical difficulties with this thing yesterday too, and I couldn't make it work. So, still trying to figure out what's wrong with this system. All right, uh, it's not working. Oh, maybe it is. All right, testing, testing. 1, 2, 3. All right, here we go. I think we got it going this time. All right, hopefully you guys can hear me. If anybody wants to give me a sound check, that would be great. I'd appreciate it. But we're going to get rocking and rolling here. Today is the class. This is the lab for our university class. So everybody's welcome. Anybody who John saying he can hear, so that's good. All right, so I appreciate that, John. So this is the university lab class. We had class last night at the university, and it was I was kind of feeding people with a fire hose. So we're going to go through today, and we're just going to kind of recover some of the things we talked about in class. We're going to apply the academic side of what we learned, and we're going to do the applied math. All right, so if that's what it is, although there's not a lot of math in these trading things because we got computers and they do the math for us, and that's pretty nice. So we're going to go through and we're going to talk a little bit about what kind of trader are you. All right, because that was one of the things we talked about last night. We're going to kind of translate that into the software that we're using. And we're going to be using Track and Trade here for that. Now, some of you might have a different platform, but I'm going to use, this is my platform. So this one I'm going to use. And I'm going to show you some of the things about different types of trading that you can do. And then we're going to go in and we're going to talk a little bit about technical analysis. We're going to get kind of a little bit of that under our belts. And we're going to go into greater details into technical analysis in a future class. So this is just kind of a quick introduction to technical analysis because I want to do a little comparison between technical analysis and fundamental analysis, just to show you a little bit in the software how to do that. And then we're going to start looking at some charts, and we're going to see how some of these different fundamentals and technicals line up together on different types of trading styles, different time frames. All right. So that's our goal, and shouldn't take us a whole hour, but we might take the whole hour just to do that kind of stuff. Usually it's pretty quick, pretty easy to kind of point that stuff out, and then we'll have a little bit of time left to go over and look at charts. All right, look at some different markets and do some comparisons and see if there's not some markets we want to put some money into. All right, and so the first thing I want to do is I want to come in and I want to talk about the two different types of trading styles. First, there's the technical analysis, and then there's the fundamental analysis. All right. So technical analysis is when we do mathematical modeling of the market. Fundamental analysis is when we go out and look at markets and see how much money the company's making and see all the different fundamentals. And I'm going to show you a couple little tricks of things that I like to do. All right. So the first thing I want to do, though, is I want to drop into different styles of trading. So the first thing we want to do is come in here, and I'm going to pull up a chart, something that most everybody's all familiar with. Y'all know a company called Apple. All right. And the symbol for Apple is AAPL. And we pull up Apple just like that. We type it into the little symbol box here. Now, again, if you have a different type of trading platform, you would probably type it in somewhere else or figure out some other way to open up your Apple platform. You have to search for it, and then you find it, and then there it is. It pops up just like that. And that's Apple. Now, I'm going to come over and we'll just for fun, I'll show you over here in this little platform. This is called FinViz. And this is a free little charting application. You can't trade on it. You can't do anything with it. You can't draw. I mean, you can draw on it, but the drawing tools are kind of limited. It's got a few icons. But what this is good for more than the technical side of things is the fundamental side of things. All right. This has a really good fundamental section that kind of helps us see some of the fundamentals. Now, the fundamentals are things like how much money is that making? What's their earnings per share? How many sales are they making in billions? Are they buying their shares back or not? Are we getting upgrades from big firms like Goldman Sachs and Morgan Stanley? What do they think of them? Are they upgrading or downgrading? They got some news reports in here. These are all fundamental. This is all fundamental stuff, all right? And then we got insider tradings all in here and all that kind of stuff, okay? So here's your insider trading. Here's your insider trading. And so we got all that kind of stuff. This is all fundamental information about your market. So that's why I like to use this little FinViz thing. They have a little chart up in here, but the little chart is kind of, it's okay. I mean, it's probably the best worthless chart on the free side. All right. Now this is free because they pop up ads on you all the time. If you buy it, well, I don't make any money if you buy it. I'm not associated with these guys. I just like them. So if you buy it, then you don't get the ads. So you see, I got no ads. I've subscribed to it. But this is the part that I like best. This is my favorite part of the screen. This is the fundamental analysis of markets, all right? To do the technical stuff, I like the trading platform. Okay, so the trading platform gives a lot more capabilities, like a Ferrari versus a Ford Taurus. This might be the Ford Taurus version of trading, and this is the Ferrari version of trading. They both have four wheels. They're both going to get you down the road. It's just one's going to be a lot fancier. Okay, so this one has everything all encompassing. You have your accounting down here, so you can see all of the money that you're trading. You can trade right on the chart. You have all of your portfolios listed in here. You have all of your stocks in here. You got everything, all of your indicators in here, more than you can shake a stick at. There's all your drawing tools for technical analysis up here. So this is kind of a, far and beyond what you're going to get on some free platform on the internet. So this is the technical analysis side of things. Okay, so what I want to do now is I want to talk about different time frames of trading. So the way we come in and we look at different time frames of trading, this is Apple, and if you'll notice up here in the left-hand corners, we talked about last night in class, this is a daily chart, all right? So see up there, it says daily. That means each one of these price bars, again, as we talked about in class, represents the open, high, low bar for that particular day. So each bar represents one day. Now, we also see down here at the bottom, we have the months. So this is August to September. See that? August to September. So during the month of August through September, let's just draw a little box around it. We come in here, and that is August to September, about right in there. So those are the price bars that represent August to September. Now, if you count them, there should be about 20 of them. We have a little bar counter in here. And not exactly 20, because we have one trading day is business day. So Monday, Tuesday, Wednesday, Thursday, Friday. So there's 5 days a week is the trading days. So we don't trade on Saturday and Sunday. Now there are some markets like the futures market, they do trade on Saturday and Sunday, or they'll trade on Sunday anyway. They'll open up Sunday evening. So you can start looking at the stock market too. It'll start to move. Your prices will start to move Sunday evening because the futures market opens up on Sunday evening and you can trade. All right. So you get some overlap on some of these markets, but for the most part, we don't get bars for Saturday and Sunday. So that's why we have 5 trading days. So you usually get 4 weeks in a month. So you're going to get 20 bars. Again, you might get a little bit more. You might get 21, 22 bars, or you might get 19, 18 bars. But nonetheless, you're going to get something close to that. And this is the monthly time frame. So you're going to get 1 bar for every day of every trading day. Now, remember the name of the bar. I'm going to turn off the Fibonacci. Now, Fibonacci to me is it's a technical indicator. All right, so it's a technical part of trading, and it's a smoothing component that's added to the price bars. So these prices that you're looking at now, I call them the cheat codes. All right, I'm going to turn the cheat codes off. So this is what bars really look like. This is what the price really looked like. All right, so you have green bars, which means that the market opened lower than it closed higher. So that's bullish, right? So a bullish market is one that has a price bar that opened lower than it closed. Now, if you look real close at one of these little price bars, you can see, I'll blow it up here really big like this. You can see, maybe if I can get it over here, you can see that it's got little tails on it, topping and bottoming tails. So since this is a green bar, that means that it opened down here at the bottom. This is the price that it opened at right there. And then this is the price that it closed at right here. But during the day, it went higher than the close. So it has a little topping tail right in there. All right, we call those wicks because this is a candlestick chart. So right down here, this is also a wick, and that's the lowest price that the price went during the day. So during the day, the market moved up and down, and this is what the price looks like on a daily chart. So you get 1 bar that represents the open, the high, the low, and the close on a candlestick. Now we fill those in, so they're those little boxes in there, so that you can see that this was it just makes it easier to see. And it's green, meaning that it's bullish, meaning that it closed higher than it opened. All right, so now I'm going to come in, I'm going to change the price bars. So we're going to come in, we're going to go in here to price bar types. And I'm going to just go to open, high, low, close. See that one? OHLC. You'll notice, and I'm going to make it a little fatter here. We're going to come in here and make it proportional width. And you can see that it's exactly the same thing. All right, we still have the open right here. We still have the close right here. We still have the high right here. and we still have the low right there. So that's the open, high, low, close. Very easy to read this way, but the candlestick is the exact same thing. The only thing we do is we draw a little box inside there, and we fill that little box in, all right, and we color it. Makes it cute, kind of like a Christmas light, okay? So that's the candlesticks. That's open, high, low, close bars. Now, if you look in here, we got, again, this is kind of like a little Ferrari of trading. So you got all kinds of candlesticks, or all kinds of charts in here. You have high, low, close as well, which gets rid of the open. So a lot of people don't think the open is as important as the close. So they just turn it off. All right. We don't need to see the open. We don't care. We have yesterday's close. So just the closes are what's most important. And so you can turn off the opens. Say we can come in here, and we've also got close only bars. All right. So that just gives you a line. Now, if you're using a program like Robinhood, this is what you're going to see. You're just going to see a close only line. Okay, it's just a line of what the closes were, because again, most people believe that the close is the only most important. Now, you can also see an open only bar, because again, this is kind of a fancy little software program. We're going to give you lots of features that you can use. Okay, then we're back to candlesticks. And then when we come down here, of course, you can turn them right off. You can say, I don't want to see any bars at all. And you say, well, why wouldn't you want to see any bars? Well, some people don't want to trade with bars. They want to use with moving averages to trade off of. And it's just kind of a different style. And we accommodate lots of different styles with this, again, very fancy software. It does lots of different things. And there's lots of things in here that you may never use because they're for other people who use different strategies. Don't feel like you have to know everything in your trading platform, because your trading platform is designed for lots of different people doing lots of different styles of trading, and you may never do that style of trading. So there's going to be features that you may never use, and that's okay. Nothing wrong with that. You don't need to do all the things. Okay. All right, so that's open, high, low, close bar. That's how it works. And now I'm going to come up here, and again, you may not have HA in your list. So HA, you come in here, you right click on your little handle, you come down here, you say customize the toolbar. It brings up this little window here, and you'll see the little HA will be over here in the left-hand side. Now, I've already moved mine over into the right-hand side on that particular toolbar. So you just hit add. Anything else you want to add, you can come in here and you can click on it, hit add, and it's going to update your little sidebar there. And you're going to get the little Fibonacci. Now, I like Fibonacci. I call it the cheat codes. And the reason is because it smooths out. It gives you a smoothing component to your bars. All right. So you come in here and you hit HA, and that gives you that little smoothing component. And then that makes it a little bit easier, in my opinion, to see those. Now, some people don't like them because it's not the exact price that you would get if you were looking at the Fibonacci bars without Fibonacci, right? It's a little bit different. Yeah, it's a little bit different, But to me, it's easier to trade. I can see the trend a little bit better. So I like to use it. Now, we'll turn it on and off. That's why it's a toggle switch. So you can turn it off and like, oh, this is what and then you're like, oh, I like this. Okay. So you can see different ways of looking at markets. Now, if you look in track and trade, and again, depending on the software program you're using, it may be a little bit different, but down here in the left-hand corner, you're going to see some tabs. Now, these tabs down here have different time frames. And of course, these are customizable. You can make them any time frame you want. But if you look down here, you're going to see a 1-minute chart, a 2-minute chart, 5, 15, 30, 60, daily, weekly, monthly. Now, what does that mean? Again, we can trade on any time frame. What type of trader are you? Are you going to be a long-term investor? You're probably going to be looking at a daily chart because you really only care about price over a long period of time, like 6 months, a year, or longer. And so this is kind of the primary chart that we generally go off of, is the daily chart. But if you're going to be an intraday trader, a shorter term trader, you can come down to some of these shorter term time frames. So if you're a day trader, you might come down to a 1-minute chart. So if you click on that little tab down there, it's going to take the Apple chart and it's going to show you a 1-minute price bar. Now, that's what it means when we say 1-minute chart. It means that the price bar, each price bar represents 1 minute. Now, it hasn't changed anything in the same regard to the way that we're using it. It's still got an open, high, low, close, but it's for every single minute. All right. So you can see this minute was real small. The market didn't move a whole lot. This bar, it did. Now, if you look down here, you can see that that's at 6:30 in the morning. That market took off like a rocket ship. All right. And rallied really hard. But then it kind of going into the morning session. Now, this is called the morning session. And in trading, you have a morning session. It generally starts at 5 o'clock in the morning. We'll get some Usually we'll get a little bit of a run out here at 5 o'clock in the morning on my time. Now that's Mountain Standard Time. See, so 5 o'clock is when the market actually opens right here, 5 a.m. So we have two opens. We have a 5 a.m. open and we have a 7:30 a.m. open. Okay. So keep that in mind. Now, remember, we're in Utah, so I'm going off of Utah time. The market is actually in New York. So New York time, it's going to be 9:30 a.m. Okay, so those guys are out there in New York opening up the market at 9:30 a.m. But for us, we have to get up earlier, 7:30 a.m. So that means here, this is 5 a.m., which is really 7 a.m. for the markets, right? We just have to make the time, and your software will make that time adjustment for you. And you can adjust it if you want to in your settings. You can come in and you can actually manage your time. And you can say, no, I want to have it show, that I'm in New York, even though I'm in Utah, and it'll show you the New York Times. You can do that. But I like to see it for my time. All right. So right now it's 5 o'clock in the morning. That's the open. Now we have what we call the pre-market session. And that's the open of the pre-market session. So the pre-market session comes in, and at 7:30 is when the real market opens. All right. When most everybody, all the retail traders trade. So we come in here, and this is the pre-market right in here until 7:30. So 7:30 right here, where all this action started to occur, is the actual open of the market, what we would consider to be the market open. Even though it does open at 5, we consider the open to be here. Now, what's the difference between trading at 5 or here? You have different capabilities with your tools. Now, there's different types of orders. We're going to talk about those in a different class. We'll get into that a little bit when we start placing different types of orders on our market. But right now, you have what we call market orders, stop orders, and limit orders. Those are the three horsemen of market of orders types. All right. Market orders, you can buy a market order, you can sell a market order. You got stop orders, you can buy with a sell order. With a stop order, you can sell with a sell order, with a stop order. We have limit orders. You can buy into the market with a limit order. You can get out of a market with a limit order. All right. So limit orders are the only order types that are allowed to be used, limit orders, in the pre-market session. That's why most traders, most retail traders, open up the market and start trading right here, because then you can use market orders, stop orders, and limit orders. All right, that's the beginning. This is the pre-market session. Most of us don't trade that unless you're going to be some kind of a early morning scalper, day trader type person trading with limit orders only. So that's why the market starts right here, and this is where the rest of the market goes for the rest of the day. Now it goes until our time, 2 o'clock in the afternoon, which of course is 4 o'clock in New York. So from here on, this is the full market session all the way out until 2 o'clock in the afternoon. And then they do the same thing in the evening. All right. Now, hold on. How come I'm not able to do this? What is going on with my charts? I got to turn off auto scale. Okay. So now we come out here, and this is going to be the last couple hours of the day. This is going to be the aftermarket session. So the market's closed for us, which is the regular market session at 2 o'clock in the afternoon. And then they have the after hour session, and it goes back to doing that same funny thing where they only let you use limit orders once again. Okay. So that's a special little thing that goes on here in the stock market. They have a pre-market session, they have the main session, and then they have an after hours session. Okay. So that's a little bit of a game that we have to play. That's part of the rules of the game, just like if you're playing Life or some other board game. This is just kind of a board game, and those are the rules. All right. Why do they do it? Well, because it makes it more fun. Okay. there's other reasons, but that's beyond the scope of this class. But for the most part, those are just the rules of the game, and just think about it like that. Okay. When you get a board game and you open it up for the first time, you turn the box back over, right, and you look on the back of the cover of the book, and it's got all the rules for the game. Well, one of the rules of the game is that during 5 o'clock to 7:30, you can only use limit orders, and after 2 o'clock, you can only use limit orders, and in between time, you can use markets, limit orders, and stop orders. And that's just the rules of the game. Okay. Now, if you're going to come down here and trade on a 1-minute chart, there's another rule of the game. If you don't have $25,000 in your account, you can't day trade. All right. They get mad at you for doing it. If you come in here and start trying to get in and out of the market more than once in the day, they get really mad at you. Now, you can get in and out like something I think 4 times in a week. All right. So if you want to do a day trading, you can do that 4 times in a week, and they won't lock your account for 90 days. But if you go more than 4 times in a week, they're going to lock your account for 90 days. Okay. We don't want that. We don't want them locking our account, locking us out like children. So just make sure if you're going to do day trading, you have at least $25,000 in your account. Now, if you want to do some day trading and you don't have $25,000 in your account, then you can do a different style of market. Now, remember, last night I told you I spent most of my time in Chicago at the exchanges over in Chicago, the futures exchanges. Then we have the exchanges out of New York, right, where the stock market is. So we have the two competing exchanges, Chicago versus New York. And New York is the one where you trade all of the stocks for, all the individual big companies. Well, over in the futures market, we can trade the indexes like the S&P 500, the Dow, the NASDAQ. We can trade some of those, and you don't have to have $25,000 in your account to trade them. So in the futures market, and we'll get into that in a future class, it's a little bit beyond the scope, but I just want to bring it up. You have what we call pattern day trading rules. Pattern day trading rules is the name of the rule that requires you to have $25,000 in your account. And there is no pattern day trading rules in the futures market. So we can get you started if you want to do day trading over in the futures market. It's just another piece of software just like this. And you open up your account to do day trading, and you can do day trading without having to have $25,000, and you can trade all day long as many times as you want without having any penalties or getting your account closed. Okay, and with a small amount. You don't have to have $25,000 to day trade. Okay, so that's just a quick rundown of a 1-minute chart. Now you can come over here and track and trade. Track and trade is very dynamic. It has lots of ways of doing the same thing, which makes it easier for you or harder. So you come down here and you see that you got all your little tabs down here, but you've also got up here, you got your list of charts. So if you right click on this, you can see you're going to get a window that opens up different charts as well. Now, you have a chart on your screen. And this is kind of a little bit of a different concept. A lot of people struggle with, but just to make it, try to simplify this concept for you. You have this chart, and I can make this chart right here be any time frame I want by clicking on these little tabs down here. So I can come in here and I can say, I want this chart right here to be a 2-minute chart. And you'll notice if I do that, all the drawings that we put on the 1-minute chart are still here, see? But now each price bar represents 2 minutes. And of course, it's going to be a little bit of a different scaling and all that kind of stuff because we've combined 1 tick into 2 ticks. So now each price bar represents open, high, low, close of a 2-minute time frame. Now I can come down here and do that again. I can make it a 5-minute time frame. And you'll notice that again, all my drawings are still here. Okay, still have all my drawings. And so I can come in here and again, look at this chart in a different time frame. It's the Apple chart, and I can make it any time frame I want, 1, 2, 5, 15. And these are customizable. All you do is right click on them, pops up in here, and you can change them to any time frame you want. But you can see I got it set to 1 minute, 2 minute, 5 minute, 15, 30, and 60. So if I wanted this one to be in 120, like a 2-hour chart, I can just change that right there, hit apply. That becomes a 2-hour chart down here. I click on it, and now that chart becomes 2 hours, and you can see all my drawings are still there. See that? Because it's the same chart. All I'm doing is I'm taking this chart and I'm changing its time frame. Now, what if I want 2 charts of Apple? I come over here to this window, right click on it, and I open up a 15-minute chart. Now you'll notice over here in the right-hand window, I have 2 charts. I have a 15-minute chart, and there's no drawing on it. Why? Because it's a different chart of Apple on a 15-minute time frame. My 2-hour chart is still there, and it still has all the drawings I had on that chart. Now I can come over here to my 15-minute chart, and I can change it to a 2-hour chart. But it's still a different chart. I have 2 2-hour charts of Apple now. One of them has drawings on it right here. One of them does not. So if I draw drawings on this one, now I come over here to this one. My drawings are on this chart for that one, and my 2-hour chart is drawing on this one. So I can have 2 charts of the same market, even at the same time frame. Why you might do that? Well, there might be different strategies that you're running on Apple, but on different time frames or different strategies on the same time frame, and you might not want one to interfere with the other. Now, if you're going to place an order, they're both going to go to Apple. So you can't come in here and say, well, I'm going to place an order on this one for a long position and an order on this one for a short position. And what's going to happen? They're just going to cancel each other out because they're both going to go to the same Apple at the exchange. This is just a window at looking at the price of Apple. So you can have 2 windows, but they're both looking at the price of Apple down here. So if you place an order on this one, it's still going to affect Apple down there. If you place an order on this one, it's still going to place the same Apple down there. It's not like there's two Apples. There's just two different windows looking in at Apple. Okay? So you can have as many windows looking in at Apple as you want. I can come in here and open up a 5-minute chart of Apple. Now I got 3 charts, 3 windows looking at Apple at different time frames. There's a 5-minute, there's a 2-hour, and here's a different 2-hour. Okay, and I got different drawings on these 2 hours. And then I can change this one over here by coming down here and hitting 5-minute. Now I've got a 5-minute here, a 5-minute here, and a 2-hour. So we'll make this one, I can right click on it and change it to be 1 minute. So now we got a 1 minute, a 5-minute, and a 2-minute. And I can change them either down here with the tabs, or I can just right click on them and change them over here. If I right click on the words themselves and open it up, now I'm going to open a new one. We'll open up a weekly chart. So now I've got a 1-minute chart, a 5-minute chart. Now these are all windows into Apple. My 1-minute chart, my 5-minute chart, my 2-minute chart or 2-hour chart, and my weekly chart. Okay. I know it starts to get a little bit complicated, but it's not too bad. Just different. Just think of them as different windows looking at the price of Apple. Okay. We're looking at Apple at different price levels, price ranges. And you can come in and do anything you want. So this is a weekly, meaning that each one of these price bars represents 1 week. So if we go from where it's currently trading right now all the way back to here, this is back in December of 2022. So that's a long time. That's 3-year period of time. Apple's gone up in value, okay, over a 3-year period of time. So that's why we say buy low, sell high, and then just hold on to it for 3, 4, 5 years, and then that's your growth. All right, that's called the growth. Now we're going to talk about yield. So there's 2 ways to make money in the market. There's growth and there's yield. Now right now we're focused on growth. So if you would have bought right here, let's say you bought right there, and you got it right here, you still own it, how much money would that be? Well, let's say that we put in 100 shares, and 100 shares at the time was trading over here. You see over here on the right-hand column, it says $124. So we're going to say right here, let's just do $125, all the way up to where it's currently trading right now. With 100 shares, you'd have spent 125, so you'd have spent $12,500. And today that would be $26,000. So you put in $12,000 and now it's $26,000. So it's almost doubled in 3 years. So if you put in $10,000, you'd have $20,000 in 3 years. Now in the stock market, we have a rule of thumb called the rule of 7. Now, generally what we anticipate is we anticipate the market will double your money every 7 years. Okay. So if you put your money in, you should anticipate that in 7 years, you should double your money. That's just kind of the way, a general rule of thumb. Does it mean it always happens? No, of course not. Does it mean sometimes you make more than double? Of course it does. This is doubled in 3 years. All right. But sometimes you lose money too in 7 years. Markets go down. Now, there's not been a time where the S&P 500 itself, all 500 stocks combined, or the entire stock market, has really gone down in the last over a 5-year period of time where we've had big losers. All right, over a 5-year period of time, it's either broke even or made money. So if you want to get into a long-term position, if you keep that kind of in your mind, that the S&P 500 hasn't lost money over a 5-year period of time, any significant amount of money over a 5-year period of time, then you kind of want to stay in markets at least 5 years. Okay. So when you start investing like that for the long term, think 5-year horizon. Okay. Doesn't mean you have to. You can definitely make money on a shorter term time frame. I mean, if you got in right here and you got out right there, you'd have made on $100 on 100 shares, which would have been a $12,000 investment. You'd have made $6,000 right there on that one little run. All right. So that would have been a nice little run from 12 to 6. $12,000 investment, you made $6,000. You made 50% of your money on that one little run, which would have been from January 23 to July of 23. So 6-month period of time, you could have made $6,000 on a $12,000 investment right through that one little period. All right. But then notice that we had kind of this little cavitation right here. You'd have made no money. Growth would have been, in fact, if you'd have bought right there, right, and then 6 months later, you'd have lost money. But then the market took off again. Went shot up like that. But it did shoot up, and then it went sideways for about 1, 2, 3, 4, 5 more months, 4 or 5 months right in here before it took off again. And then on these next, look at this. This will come all the way back down. So 1, 2, 3, 4, 5 months. It came all the way back down. And then for 4 months, it went sideways before it took off and ran again. All right. So you just have to take that into consideration, looking at staying in a market for a long time. You're going to have times in your investment world where you might go for a whole year losing money, all right, before the market takes off. And then you go another four months before the market takes off. And then you might sit through a long drawdown. Look at this, from here to here. We're finally just coming back for all the people who bought right here. And then they sat through this whole thing. 1, 2, 3, that's a whole year they had to wait just to get their money back. Okay. So you have to take that into consideration. Markets don't always just go straight up. So this is a long-term view of Apple. If you'd have been in Apple, that would have been the ride you'd have had to take. Up and down, up and down, up and down. Now this brings me to yield. Again, there's multiple ways to make money in the market. There's growth and there's yield. Now we're not going to talk about yield today. We're not even going to talk about yield until next week. Next Tuesday, we'll have our next class and we start to talk about yield in next class. So that's why I think it's important to start to learn about growth and yield. So right now, this is growth. We just buy low, sell high. And if you don't sell, you never realize your profits, and so you never make any money. You made the money, it's all on paper, it's sitting in the markets, but you can't go spend it until you sell it out up here. You want to sell it when it's high so you can take it and go buy a new Tesla. All right, that's how you make money in the stock markets, with growth. So you buy down here, you sell it up there, and you go buy a new Tesla with your money. Okay, so that's a 2-hour chart, 5-hour chart, 1-hour chart, or 1-minute chart. And again, you can put on Fibonacci, you can put on the cheat codes down here on a 1-minute time frame. Now you'll notice that on a 1-minute time frame, you got a real hairy little price bar, lots of hairy tops and hairy bottoms. All right, lots of whiskers on these things. They need to shave. We don't like a lot of whiskers. All right, when we're trading, let me blow this up a little bit, on a real small time frame, even on the longer term time frame, we like flat bottom Fibonacci bars. Now, if you turn Fibonacci, you're going to not have flat bottoms and tops very often. They're pretty rare. But when you turn on Fibonacci, you get lots of flat bottoms. See that? No whiskers coming out the bottom of that whole trend right there. That's what you want to trade. Those are what you like. You like those. Now, it's okay for them to have whiskers on top, but you don't want whiskers on the bottom. So if the market's got whiskers on the top and whiskers on the bottom, right, you don't want to trade during that time frame. Why? Because it's going sideways. Market, you don't know if it's going to go up or if it's going to go down. It's very indecisive. But when you have lots of whiskers on top and no whiskers on the bottom, that becomes a very bullish market. It's got a lot of strong sentiment, and it's a nice rally market. It's on its way up. Okay, so that's good. And then same thing coming down. If you're going to short the market, see how we got no whiskers on top? We got flat tops. That's good. We like flat tops for a short position. That means the market's strong. It can have whiskers on the bottom, but we don't like whiskers on top. As soon as it starts to make whiskers like this, we want to sit aside. This is called a neutral market. And we have another tool in here called the bulls and bears. And I'm going to turn it on, chart overlay. Bulls and bears that you can apply to these markets, and it starts to tell you where you're going to probably see a bunch of whiskers, which is the yellow zone. So the yellow zone is the neutral zone. So we got a little bit of neutral in here. So that's the changeover from bullish to bearish. Okay. Again, bearish means the market's going to be red on the way down. Bullish is a green market on the way up. And so you're going to have a neutral market is the transition between bearish, neutral to bullish. So that's a nice little tool in there. And it's got some other additional benefits to it that are a little bit beyond the scope of this class. We'll start talking about technical analysis in greater details, where we'll start talking about Fibonacci and Elliott Wave and recurring price patterns. And we touched on some of the recurring price patterns in class last night. But again, that's beyond the scope of this class. We're just going to kind of stick to what we're seeing here, just looking for, and what we like to talk about is the trend. And I'm going to talk about the trend. We did talk about the trend last night. Remember, this is the most important, single most important tool that we have in technical analysis is the trend line. Okay, so we draw that in there. You can see we got a trend. For every down, there's an up. For every down, there's an up. Okay, and this market's coming up. We got a progressive trend line. It turned, started going a little bit stronger right in here, but we draw our trend lines in here underneath the areas of support. So support is on the bottom, resistance is on the top. Last night, Chad asked, What he asks is, why don't you draw your lines above on the top side land? Well, we do on many occasions for these different recurring price patterns, but for just a normal trend, you can draw it along the top. That's your resistance. So think of it as the ceiling. Markets have a tendency to go up and touch that resistance line. And then on the bottom, we have the support line. So support is the floor, resistance is the top, the ceiling, and the market has a tendency to bounce between those price levels. Once the market breaks this natural trend line in here and starts to go this way, well, it broke that trend line. That's what we call a setup and a trigger. All right. So the setup is that we have a nice long uptrend happening right here. Market's going up. And then the trigger for a short position or to get out of the long position would be when it broke those trend lines. So when it breaks below that nice, see how that nice line going up in there? As soon as it breaks below that, well, that would be a trigger saying that the market's no longer making higher highs and higher lows. We want to get out. Well, that's where you'd get out. Okay. So that's how you come in and you get higher highs and higher lows. That's the definition of an uptrend. Lower highs and lower lows. That's the definition of a downtrend. And then that's how you come in here. And that's how you get your setups and triggers. So setups and triggers can be in every way. Scott's saying, thanks for teaching this. You are welcome. And I appreciate the kindness. And so now we're coming in here and we're looking at, this is a 1 minute time frame. So we can do the exact same thing. Remember last night I said that when you do technical analysis and you look for your setups and your triggers, and there's indicators down here too. Now, we'll talk about these in a minute. I just want to talk about the lines up here on top for a minute. Now, most of these tools up here, you're going to look at them and you're going, oh no, this looks overwhelming. Really, all these tools are just shortcuts for drawing what you can normally draw with a trend line. You can just draw with one of these little tools here. All right. So let's come in and I'll show you an example of that. So I can come in here and let's go out to a 5 minute chart just for fun, just to do, well, we're not getting many patterns on. Let's stick to the 1 minute for now. So I'm going to come in here and I can draw my trend line across the top of this one and across the bottom of this one, and I can get a little channel like that, right? See how I got a little channel in there? Well, that just means that I had to draw the trend line twice. And this one's a little crooked. I wasn't very good at drawing it, so it's a little crooked. But we can go ahead and we can delete those and watch this. I can show you here, and I'm going to get rid of this indicator too. All right. So now I'm going to come in here and I'm going to get rid of this one too. Oh, no, I'm going to keep that one. So we're now got this tool here. See this tool? I can grab that one tool and it just draws both of them at the same time. So this tool is just a shortcut for drawing two trend lines. And it's got a little different color and it's kind of got a little fill in there. It's kind of cool, right? And so anything that you want to change on these little tools, you have a preferences tab over here. So if you click the preferences tab, then that's going to show you all the preferences for that tool. And as long as the preferences tab is open, anything you draw is going to pull up the preferences. So if I'm going to draw a circle, right, now the preferences for the circle pulls up. If I'm going to draw a square, the preferences for the square shows up. And I like that because then you don't have this box popping over the top of your chart while you're trying to trade, and you can make adjustments to it right here and see them in real time. All right. Again, that's another advantage of having a high-powered trading platform designed for traders who don't want to have their charts covered up and then want to be able to change things on the fly while the market's moving, and they can change the colors, they can change the mathematical modeling or whatever they want on the fly and see it as it occurs. Okay. It's very important for traders to be able to do that. And that's what a trading platform gives you, as opposed to something like this, where you would just have to go into some settings, you set them, you come back and see what it looks like, you go back into the settings, you set them, pops up a little box over the top of your screen, you know, it covers up everything that you're doing, and then you have to have this little box and you make the changes here and you can't see what they do to the chart until after you apply them, and you hit OK and you apply them, and then it comes up and then you can see what it did and you don't like it. Now you have to come back and you have to do it again. So just lots of shortcuts that a Ferrari will give you versus a Ford Taurus. All right. And being able to actually place orders right here is a big advantage as well. So now as you come in here and we're going to go back over and I'm going to show you some of these other shortcut tools. This is a little channel tool. All right. But now I might want to draw not only a little channel, I might want to say, well, I want to do some math on this thing. So I can come in and I say, I'm going to draw the low point down here. I'm going to draw the high points up here. And I want to know where the halfway point is. So the halfway point's like right in here somewhere. You can do it like that with your trend line, or you can come in here and you can drag a little tool up here that does all three of those with one fell swoop. All right, just like that. And then you're like, oh, that green color, I don't like it. So you can come in here and say, well, I don't want to have that green color filled. So you can come in here and you can say, I'm going to get rid of the black. There, I just want it like that. And I'm going to make this a little bit thicker, and you can do that. Okay, so now you can customize it, make it look like whatever you want. It's got fonts in here. And you say, oh, I want those to be a little bit bigger. You can come in here and you can make them a little bigger. I don't know, I want them to be bold. Okay, so you can do all kinds of fun things like this for drawing your technical analysis tools for setups and triggers. So markets have a tendency to move through a wave pattern, right? They'll go up and down, and they'll kind of go through this wave. And you can see this little wave right now. It came down here, and then it's waving right back up. Oftentimes what will happen is the market will come down through this wave. It'll turn and go back up, and it'll stop right at the same place that it started up here. And so you want to measure that. And then it has a tendency to come back down to the halfway zone. So that's a setup and a trigger. So you can draw your little trend line in here, and you can say, okay, if it breaks below my trend line, I'm going to get in short. I'm going to take a short position. Or if I got in down here on the downside, right? Oh, there's the switched over from red to yellow. I got in right there. I bought right there. I'm going to ride it all the way up through the green trend till it breaks the trend. And it should start looking to break out up in here. Or you can just take your profits right up here, saying, hey, it's getting close to where it was. Probably going to start to peter out up in here or fall. I'm going to take my profits up in here. So that's what some of these tools are here to help you with. All right, just some little ideas. And again, getting into technical analysis, this is a little bit beyond the scope of this class. We're going to go into this in greater detail in not next week. That's our next class. The following week after that is off. Then we have the technical, then we have the advanced class on yield. So we're going to have yield class next week, and then we're going to do advanced yield class the week after that, and then we're going to go into the technical analysis class after that. So this will get into great detail, and I've got a whole nother book with all kinds of plays and settings. And again, remember, we talk about it as if we're playing football, and we got a book of plays, and we're going to play our offensive plays and our defensive plays. Now, this is on a 1-minute chart. Doesn't mean that if just because I'm showing you these examples on a 1-minute chart, we can do these on a daily chart as well. So I'm going to come in here and open up a daily chart. So now I have a 1-minute chart on my Apple chart. I have a 5-minute chart window. I have a 2-minute window. I have a daily window, and I have a weekly window. So if we come back to the daily window, we can do all the same things. Again, I'm going to turn this off right here. We can draw our trend lines just like we did before. We can draw our little recurring price patterns just like we did before. We can do our little ABCs, our little sideways channels. We can do all kinds of things in here with all these little tools, most of them being just basically a shortcut to drawing a simple trend line. So anything you can do with the trend line, there's probably a tool in here that'll help you go a little bit faster and easier. All right. And some of them have a little bit of mathematics included, like this one, for example. It'll do some math in there, how it draws it. See how it draws it with a little bit of math. All right. So math is helping you draw some of these channel tools. All right. So that's kind of a neat little thing. And then some of them have different strategies involved, like an ABC pattern, something like this kind of gives you this little pattern indicating mathematically where we anticipate the market going based on where it's been. So past performance is not necessarily indicative of future results, but it's the best information we've got. So we want to go off of those recurring price patterns in the past to predict what the market's going to do in the future to help us make money. All right. So again, this is all about growth, and we want to be good at understanding when markets rise and fall so that we can play against that. We can get in during the rallies and get out during the falls. All right. So we can make money when the market's rising, or kind of get out so we don't have to sit through months and months of down losing money. All right. And that's the whole name of the game. And that's what these indicators down here in the bottom window are for. They're to kind of help you have an idea. And this is one of my favorites. It's called Chalk and Money Flow. And it kind of helps you identify when markets are down in low regions down here. And the reason they're green down here in the bottom is because we generally consider this a buy zone down in here. All right. We want to start to buy on the way down, and we want to sell on the way up. Now, I touched on this a little bit last night, because this is what's called the accumulation distribution stage. And we don't all go in. We don't just go in and say, oh, I got $10,000. I want to invest in Apple. So we don't go in and just say, okay, I'm going to, like I'm at a blackjack table, and just slide all my chips in one at a time or all at once. We want to put a little bit in at a time, okay? When these markets are kind of telling us that it would be probably, mathematically speaking, based on past performance, not necessarily indicative of future results, but it's a pretty good little indicator, and it can generally tell us when we should start doing our simple accumulation of shares. All right. So usually when the market starts first coming down like this, we as small speculators, we're too small to start adding in right up in here. So we don't. So we look at this drop down in here on this green. As it starts coming down on the green, we generally want to wait until it stops and starts to go back down up. We might put a little bit in there. And then it started to go back up, and that was good. And it was doing this thing. It was telling us math. But then the market turned, started to flush down again. So this green started to go down again. So we wait. And the green starts to go up. Oh, there's a spot we might want a dollar cost average in. So we might want to put in, if we got 10,000, we might want to put in 1,000 or 2,000 here. We might want to put in another 2,000 or 3,000 here. If it comes down, we'll put in another 2,000 or 3,000 here. Well, it didn't come down. It went up and then started to come back down, and it gave us another opportunity. So here we are. The market's coming down a little bit like this. We're wait. It starts to go back up. We look at the market. Oh, it's kind of coming in here. It looks like we got another little signal from one of our math indicators right here. It's breaking above. It's going green. This is starting to go up. We can maybe add a little bit in right in here. And then as the market starts to go up, now we're in at an average price, right, of all this added together. So 2,000 here, 3,000 here, 1,000 here, 1,000 here. So we got, maybe not our full 10,000 in, but we got almost all of it in right through there. And it took us 1, 2, 3, maybe 4 months to get our full 10,000 in. But we did what we called accumulate. All right. This is accumulation. So the accumulation all down through here. Now, as the market starts to rally, remember, the only way you make money is to buy low and sell high. So the other side of buying is selling. And if you don't sell out, the market will probably turn around and eventually come back down to where you got in, and you won't make any money. All right. So the markets like to go up. So they go up, we'll drive 1, drive 2, drive 3, might make another 4th drive. That's okay. But eventually the market will probably flush and come back down a little bit and give other people opportunities to start to accumulate once again. So this is called the distribution stage up here. So that's why it's red. This is where you're going to sell out your shares. Okay. So as the market comes up, you might want to, when it hits these peaks up in here, you might want to sell some. When it hits another peak up in here, you might want to sell some more. But it's another peak up in here, you might want to sell some more. You don't have to sell it all because you don't know how high it's going to go. So you keep some of it in there, but you take a little profit in there. You got to buy some food or buy some groceries, or you got to go pay the electric bill or something. You can take some out and go pay your bills with it. That's what that's all about. That's kind of an idea of you're in the distribution stage. All right. So the distribution stage is where you're going to sell out so you can take some profits off the table. Now, the biggest problem that we have, that's called accumulation distribution. And what you're doing with that is you're building yourself a nice little base down here. So you have a wide base and you have a pyramid that looks like this. So you bought the majority of your shares down here, and then as you went up, you sold out. So when the market gets way up here really high, you don't have very much left. So when it falls and starts to fall, you don't lose a whole lot. All right. You just lose a tiny little bit because that's all you got left. All this was here, and then you sold out all the way up. Most retail traders do just the opposite, and this is why they lose money. All right. 80% of retail traders lose money, and this is the reason why. Because they don't buy down here, because they don't like to buy low. They like to buy high. They like to buy markets that are rallying and taking off. So they come in and they say, oh, the market's doing well, I'm going to buy some. Oh, the market's doing well, so I'm going to buy some more. Oh, I'm going to buy some more. I'm going to buy some more. So what happens is they end up with what we call an upside down pyramid, where they end up with a dollar cost average that looks like this. All right. So their pyramid is like this. So they have a whole bunch of shares up here, and then their average price, because they keep buying all the way up the stairs. So up in here, they got their full average price is up here. Now what happens if the market just falls this far? They've lost everything. All right. So they built themselves an upside down pyramid. And that's just a bad habit that retail traders do, is that they buy high, they buy all the way up the trend. So they get a dollar cost average way up here. And it doesn't take much for the market to fall, and they lose all their money. Now they're like, well, I'll just hang on to it because it'll eventually come back. Okay, well, that's that little saying that we said last night. I said markets can stay irrational longer than you can stay liquid. So this market might start to flush, and it's going to come back. Oh, I'm happy it's coming back, and then it flushes again, and then oh, I'm happy it's coming back, and it just keeps going down. Oh, I'm happy. Oh, then I'm sad, and now way down in here, you've lost almost everything you got, and you're like, oh, I still got $300 left. I'm just going to take my $300 and get out. And now what happens? That's when the market starts to turn and start to go back up again. And over the next year, it'd take you that whole year for you just to get back to break even. Okay. So that is trading, and that's what it's like. And if you're going to stay in there for 5, 6, 8, 10 years, that's okay. You're just going to kind of sit through those things. But eventually you're going to have to take some money because you got to eventually, if you retire and you're like, well, I'm going to live off of this and supplement my income, you got to still sell some. So you got to learn how to sell, and you got to learn how to buy, and you got to learn how to get in, you got to learn how to get out, so that you don't make a whole bunch of money, which is what a lot of retail traders do, make a whole bunch of money only to give it all back. All right. And then not make any money. And then they wait another year for it to come all the way back. And then they finally make what they would have made 3 years ago. Okay. So it takes them 3 years to make what they would have made in 1 year. So that's kind of the nature of the beast. And it's kind of a nasty beast sometimes. So you just have to take that into consideration, that that's what you're doing when you're trading. So that's just Apple. All right. So now we can come over, and that's the technical analysis. That's the technical way of looking at it. That's all. What I showed you here is called technical analysis. Now, there's lots of little indicators down here, and you can right-click down here in this box. It'll show you a whole list of them. Here's the AD. Here's the ATR. Here's the %B. Here's the BW. Here's the CCI. Here's the CMF. Here's the FSTO. Here's Gator. There's more than you could ever worry about. All right. So again, you don't have to learn every single one of those indicators in the stock market, because there's just too many of them, and they're for different people doing different strategies. For us and for our purposes, we're going to focus just on a couple of indicators. All right. So I'm going to turn off the ones we don't need. We're going to turn off ATR. We're going to turn off AD. We like AD. We're going to use the CMF or the MACD. I'm going to turn off CMF because that's the one we were looking at. MACD is a nice one too. We talked about MACD a little bit last night in class, but MACD is one of these. It's very similar to CMF. If it's below the zero line, see how we got a zero line across here? If it's below the zero line, this is the accumulation stage down in here. And remember where I said when it turns and starts to go back up, that's where you want to start to be buyers? Well, the MACD kind of shows you where that is. So this little red part, this would be a good place to add in some money. Right in here might be a good place to add in some money. Maybe right in here would be a good place to add in some money. Right in here would be a little good place to add in some money. Maybe right here would be a good place to add in some money. Right? So these are your little accumulation stages down under here. Now, once you get up, you say, well, this might be a good place to sell out, take some profits. This might be where I need to take some money off so I can pay some bills. This might be a good place to take some money off to pay some bills. Okay? So here's another spot. I might want to get in a little bit of money right back in here. It's not all the way down here. It's not the most optimal, but it's turning and it's starting to go back up. There might be a chance this rises. You look at it, you draw your trend lines, and you do your technical analysis. You look at the price, and that's what you're doing. That's how you trade. You kind of use these little indicators to kind of help you know where the accumulation stages are and the distribution stages, where you take profits versus where you get in and take and get into the market accumulation. So you can use MACD. I like MACD because it's got the two colors as opposed to the CMF, chalk and money flow, which just basically shows you the same thing, but it's a little bit different view, has a little bit different mathematical model. It's not exactly the same thing. It's just a little bit different. But this one is kind of somewhat of a little bit easier to see because it's got red to green down below in the accumulation stage, and then red to green or green to red up here in the distribution stage. And again, there's some others that we'll use. One of the others that we can use, we'll talk about in greater detail, some of these other indicators, but one is stochastics, and I kind of like that one too, but we're going to not go into that one because it's beyond the scope of this class. All right, so there's other indicators we're going to talk about in future classes, but right now, just kind of stick with the MACD or the chalk and money flow, and maybe MACD for now. All right, so we'll just stick with that, kind of look at the bars, the colors, the codes, and identify where it's time to get in and out of the market. This is the daily time frame, so that's your investing strategy right out of the gate. Simplest, easiest form of getting started. Okay, and we can go over now. Now we're going to go look at the fundamentals. All right, we're going to look at the fundamentals of Apple. So we're going to switch over to the little program that we use for fundamentals, which is this program. And we're going to slide down. We have Apple pulled up. The way you get Apple to pull up is you just put the symbol right up here in the ticker symbol. So you go AAPL. And if you spell it wrong or something, it'll show up in this little list, and you click on it, and it opens up the chart. And we're going to slide down here. And this is the most important parts this window here of this little program. This is why we love this little program, because it's got all the fundamental information. Fundamental information, again, is being the, how many sales they have this year versus past years. Are they making money? Are they losing money? What are the shares outstanding? Now, remember, we talked about shares outstanding last night in class, we talked about that because we have a certain number of shares that are available that they've sold to the public, but they still have some shares that they hold themselves. All right. So Apple, the company, there's 100% of their shares, right? However they want to break it down, how many shares they made, but 100% of their stock, but they don't give all of it out to trade in the public. So they only have a piece of it that's available to the public to trade. That's called the float. How much is available out there for you to buy? All right. So now you come in here and you can see that Apple has three basic numbers across here that we're interested in. The middle one is the most important. Sales and they're in billions because they make billions of dollars. So they're a big company. So every year in 2016, you can see they made $214 billion. 2017, they made $228 billion. And then 2018, they made $265 billion. Now they had a little bit of a rough patch here with 2019, where they made $265 billion in 2018. In 2019, they only made $259 billion. Then they made $274 billion, and then in 21, whoa, they made a big jump up here to $365 billion. And then 2022 was a good year for them, went all the way up to $394 billion. Oh, 23, not so good. Went down to $383 billion. And then 2024 down to 391 billion, back up to 391 billion. But you can see over the last 21, 22, 23, 24, they haven't really made any more money. They're not in an uptrend. They're just kind of flat. It would be nice to see Apple making more money. We don't want to see them go flat, but they become such a big, enormous, giant monster. And they haven't really come out with anything new. They got the iPhone, and they try to come out with a new iPhone every year, but everybody's got to the point where they're like, okay, so you made me a little bit better camera. I guess I'm going to skip a year, maybe two, because they really don't change them much anymore. And so people have stopped buying their iPhones incessantly, and there's, and that's really kind of their big sales. They got these little Macintoshes that they sell, little laptops, little computers, but for the most part, they're a cell phone company. That's where they make all their money now. And they're just not selling new cell phones at a greater rate than what they were before. Everybody who's got an Apple iPhone's, everybody who wants one has one. And then they just, they roll them over every couple of years now. They don't just do it every year. So they've just kind of flattened off there. Apple needs to do some innovation. They really do. They've been suffering a little bit. And so because of that, they've been buying back their shares. All right. Because earnings per share, now remember, we have a limited number of shares and we have the sales. So that's what this calculation here is earnings. How much money are they earning? Billions. Versus the number of shares they have. So they just a simple mathematical division. Take the number of shares, divide it by the number of sales that they're making, and you get the earnings per share. And so now what we see is that the earnings per share were going up, 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 up. Oh, nice jump. Oh, we're all happy. And then suddenly 2022, 608, it's going down, their earnings per share. But yet they're doing a little cheaty thing here. Their earnings per share are staying flat, right? But look what they're doing to their outstanding shares. They're buying them back. So there's shares of the market out there, and they keep buying them back. All right. Buying their own shares back. That's weird. Why would they do that? To prop up their earnings per share. Because if they didn't buy them back, their earnings per share would go down. And most people look at earnings per share to decide whether they want to buy the stock or not. And if you stop buying Apple stock and go buy it with somebody else, well, then Apple doesn't have money that they can use to go buy something else, all right, to use for an investment. Or a lot of the people at Apple own Apple stock, and they want their shares to go up so they can make money too, right, owning their shares. But because they're not making any money, they have to buy their shares back to prop up their earnings per share so people will keep buying Apple stock when Apple stock isn't worth buying. That's what's happening here. And you can see that in this little chart. Otherwise, you wouldn't know that. You would look at this chart and you say, oh, Apple's doing really well. Oh, I'm so happy with my Apple stock. Oh, what a great investment. I love Apple. Apple's so great. I got my little iPhone, and I really think my uncle's brother's cousin said that Apple is a good company, and I bought into Apple, and it's doing so well. Well, in the past, it has. But now it's kind of suffering. Apple kind of sucks. Not a very good company right now. They're making big sale. I mean, 391 billion is a lot of money, but it's not growing. Look, it's not growing. The last 4 years, they haven't grown anything. They're dying. And they're hurting and they're scared. All right. Apple's running scared and they don't want you to bail out of their company. They don't want you to sell your shares. So because you're not making any earnings per share or staying flat, even though they're buying their own shares back, propping up their earnings per share. Now, people will tell you, oh, that's a good thing. They're buying their shares back. Companies buy their shares back for usually because they're in trouble and they have to prop up their stock. Now, if you own the stock and they buy their shares back, sure, it can be good for you. Why? Because it's going to prop the stock up. It's going to make the stock rise because they're pulling back their shares. They're buying them, but they're buying them themselves. Oh, okay. Apple has so much cash on hand, they're going to buy their shares back and share it with you. No. Well, the only reason companies buy their shares back is because they're scared of what's happening here. They're not making any money and they need to prop up their earnings per share and they need to prop up their share price to get more people to buy their stock. And Apple's really bad at that right now. You can see Apple is really suffering. All right. Now, you can come in here and see how they're doing right now, because right now it says this is all 2024. Well, did they turn it around? Are they making a little bit more money this year? Well, we can come up here and see their current sales are 408 billion. All right. So they were at 391. So yeah, they're making more money. They're going to actually have a higher return here in 2025 because they're at 408. 2024 was 391. So you can see, oh yeah, they are making more money. They must have done something to turn something around. They're making a little bit more sales here. They're up to 408 and we still have 2 months left to go, right? We still have November and December, big Christmas months. So it looks like Apple's going to do okay. They're going to beat 2024 quite significantly. And so that's starting to show through in the stock. And that's why your stock is starting to rise up in here. All right. So can you see the relationship between whether the company's doing well and making money, whether they're buying their own shares back to prop up their stock, or if their earnings per share is increasing or decreasing over time, and how much money they're making today versus how much money they've made in the past, and are they making more than they were? Therefore, you can see that it might be a good investment and you can come and buy in it. That's called fundamental analysis. All right. It's got nothing to do with drawing trend lines. It's got nothing to do with MACD indicators. It's got nothing to do with sentiment market indicators. It's got nothing to do with that. It's all about the fundamentals of the company itself. Now there's some other big companies, big banks that'll come in here and they'll tell you what their idea is. They think that, oh, they upgraded. See, Loop Capital, one of these great big huge analyst firms, they came in on October 20th. They upgraded Apple, saying that they think Apple's going to go up to $315. Now, Apple's currently trading at 261. So they think that it's going to go up to 315. Well, that would be kind of a target place for you to think, well, if those big boys think it's going to go to 315 and I'm at 261, you might want to do your technical analysis and figure out where you can buy into the market on a dip and decide that maybe that might be a target place to take some money off at 315. That would be a target place that these guys have said that they think the market's going to. But on the other hand, you got Jeffries down here who just a couple of weeks earlier downgraded Apple and said, well, we think Apple sucks and it's going to go down to 205. Okay, well, where's 205? That's clear down here. If they think Apple's going to go clear down here and drop all the way back down to here, why do they think that? I don't know. You might want to go and ask Grok to tell you why they think that, and you'll probably get a report that tells you why they think the market's going to flush all the way down here to 204. Okay, but that was their downgrade on Apple. They don't like Apple. It's underperforming. They think it's going to go all the way back down to 205. Okay, these guys think it's going to go up to 315, but that's what makes a market. Some people think the market's going to go up, so they'll buy. Some people think the market's going to go down, so they sell, they get rid of it. And right here, we got conflicting information. Wells Fargo, they're saying, well, I'm going to reiterate what I said last time. I'm just going to tell you, well, if I said to buy it last time, I'm going to tell you to buy it again this time. We don't know what that reiteration was unless we go back and look through history, but we can see the price target right here. We can say they think it's going to go between 245 and 290. It's currently trading at 261, so 245 to 290. Well, it's right dead center right now. So way to go, Wells Fargo. You're a real good guess there with a 245 to 290 price level, and it's sitting right between that right now. So that's basically worthless. All right. Lots of these big banks are pretty much worthless. You can do better yourself. But then there's news that comes out, and news, People generally write news because they write articles and they have to write news. The articles don't know anything. Generally, what happens is the market moves and then they write an article about why it moved. They rarely tell you about how it's going to move. Okay. Apple's going to go up. No, they don't do that. They come in and say, oh, Apple went up and this is why. And then they look around and they poke around and then they try to figure out a reason why Apple went up and then they write an article about it. So that kind of stuff is usually worthless. All right. Okay, by the time you hear the news, it's too late to take advantage of it. Okay, so that's kind of the technical analysis, the fundamental analysis, and the two different tools that we use to make that happen. All right? All right, that's the end of class. That's all I got for you today. That's a review from what we did last night in class at the university. We can go look at a couple other charts real quick here. Let's look at AMD just because they're in here. Look at this market. Oh, my goodness. What a great market. I'm glad I own a bunch of this. How much of this do I own? I should look and see. I'll tell you how much I own. Let's see. Hold on a second. I'll tell you how much AMD I have. Maybe I have some AMD. I do. Let's see. I don't have very much. That's sad. I only have $12,000 worth. Let's see if I have any in another account. Oh, I do. Oh, no, that's the same count. No, I only have $12,000 worth of AMD. Well, that's sad because that market, look at this going to the moon. That's taking off. That's really making me some good money. I'm happy I got it. Okay, so AMD. Look at those little indicators down here. Let's turn on the MACD so we can learn a little bit. We'll turn off CMF. And MACD, it wasn't in a real deep buy zone until way back here, was it? And then it went up through this whole thing, and then it gave us a little bit of a buy zone right down in here. It's pretty shallow, but you can see where it went from green to red, red to green. And then, so that's your kind of your, let's raise this one up, not that one, Lan. Here we go. All right, so there you go. See that? Kind of a little, there you go. So there's your little zone right in there on the MACD where it was saying right in here was a little accumulation stage. Now it was shallow. So you might have thought, well, I don't know, it might come in here and might come down here and give me another opportunity down here. But nope, it took off like a rocket ship. So that's how you read this. And you look at AMD and you're like, well, I wish I'd have been back in here where it said to accumulate, but I wasn't. Okay, right in here. I wish I'd accumulated, but I didn't. Now, are you going to go buy it right there? Probably not. Look at the MACD. It's going from green to red right here. Now it'll turn around. Tomorrow will be a green right in here. This will turn into a green because it shot right up there again. So it's breaking that little top formation, right? We draw our trend line across there. And that's your setup. That's your trigger. So right there, if it holds above that, that could be a buy signal. You could buy into it right there. But, you know, it's way up there. It doesn't mean it can't go higher. It certainly can. So what would we do? We just anticipate a continuation of a rising trend. But eventually we would anticipate it's going to go up and make a little pullback, break these blue lights. See how it breaks the blue lights? Break, break, break. That's what those blue lights are there to do, to tell you when they're going to probably break those blue lights. When it breaks the blue lights, that's where you can look for this and see if you can't get in for the next rally up. Okay, buy the dips. Buy the dips. Don't buy the rallies. You'll build your upside down pyramid. Buy the dips. Okay, so that one. Now we can go over and look at AMD from a fundamental standpoint. So we'll come over here and we'll look at AMD. Sorry, my voice. I'm losing my voice. All right, so here we go. We're going to come in here and we're going to go AMD. Okay. And did that little thing, I wonder when that thing fell down. Couldn't see my face. Not that it really matters, as long as you can hear my voice. Okay, so now we're going to come in here and we're going to slide down. We're going to look at AMD. Now, AMD, we come down here. First thing we're going to see is, earnings per share. Ooh, it's been struggling a little bit. You know what? But you know what? It's a more honest number. They're making earnings, sales. Look at this, sales in billions. They're going up. Now, they didn't do as well in 2023, but 2022 is done. They did pretty good. They dipped a little bit. Now they're way up on 2024. What's 2025 doing? They're at 29.6 billion. Oh my goodness. And last year was 25.79 billion. They're already at 29 now, and they still got 2 months left to go. Woo-hoo-hoo, that's good. Earnings per share, trailing 12 months, year over year, we're at a 1.74. Next quarter's 1, next year 6.2. Earnings per share next year. Wow, they're anticipating 624. They're sitting right now, trailing 12 months is 1.74. And last year, 2024, was 1.0. So their earnings per share are great. And notice they're not buying them back. They're not buying them back. In fact, they're putting more out. They want to grow. Okay. Shares outstanding. They raised them up. Woohoo! That's good. And their market's going to the moon without buying back their shares. And their sales are going through the roof. This is a good company, not like Apple, buying their shares back. Their sales are flat, and their earnings per share are only going up because they're buying their shares back. See the difference? And look at all these big companies in here. Upgrade, upgrade, upgrade. Now, these two aren't very happy about them, but that was back in September. Downgrade, downgrade. And that was probably back when the market was coming here. So now they're upgrade. Look at this market, taking off like a rocket ship. That's a good company. We're glad we're in that one. You can come in here and you can see your mathematical models down in here, and away you go. That's the way it works. So we're happy with AMD. All right, guys, I've run out of time. We're going to let you go. The first thing I want to do, though, before you run off is ask you if you wouldn't mind go over and set yourself up with Track and Trade's software so that we can work together. All right. I know Track and Trade, and I can help you trade if you use Track and Trade. So here's the software that I use.
Okay, this is the software I use. It's called Track and Trade. They've got two versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, so get your software if you haven't done that yet. And then, of course, the other thing we want to do is we want to get the Pitt News Magazine so that you can stay incognito with us. Incognito? That's not the word I'm looking for. In touch with us. That's a better word.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com, Pitt News Magazine. News your way.
All right, so for right now, you can get Pitt News Magazine the first 2 months for $1. And if you like it, you can keep it. And then after that, it's only $39 a year. And it's all kinds of really great, wonderful stuff. Maybe in our class next week, I'll pull up a copy of Pitt News Magazine. We've run out of time today, and I'll show you what it looks like. You can see the current version, and it's really fun. And we're working really hard, getting ready for the November issue. And I'm always so surprised at how good they turn out. I'm like, man alive, this month was so good. How are we going to beat that next month? But we always come out with something great every single month, and I've been so surprised we've been able to accomplish that. Every month comes out really good, but that's a credit to a great team that we got put together. And I love my team at Pitt News Magazine, everybody who helps make that happen for us. So join Pitt News Magazine so you're not left behind, and we will catch you guys in class. Hopefully you signed up for the next class, because we're going to start talking about yield. Again, growth and yield. So now we're going to start talking about yield next Tuesday evening. So that means that our next class on YouTube will be Wednesday morning, which will be the lab for the Tuesday evening class. Then we'll have class on Thursday evening, and then Friday morning will be our next lab class here on YouTube. All right, guys, we will see you then. Take care and have a good weekend.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.